There are two possible scenarios for the housing market in 2024. In scenario one, both mortgage rates and housing prices go down. In scenario number two, both mortgage rates and housing prices go up. Which one is more likely to happen? It depends on who you ask.
Nobel Prize-winning economist Joseph Stiglitz says that the Federal Reserve was directly responsible for driving up housing prices to current levels. If he's right about that, what the Fed does next will determine whether home prices become more affordable or less. In today's video, I'm going to break down Stiglitz's economic theory to show you why he thinks the Federal Reserve is responsible for this home inflation. We're going to look at the economic theory the Fed is basing its decisions on, and then we'll take a look at one more housing economist, Lawrence Yun, who believes that rates will drop in the spring and buyers and sellers will finally be able to jump back into the housing market. Which one of them is right? Let's find out. Last week, NAR economist Lawrence Yun predicted that in 2024, home sales will spike 15% due to an increase in housing inventory. He thinks rates will be down below 7% by spring, pushing more people into the market. Many people have been hoping that when inventory finally increases, home prices will come down, but all of this hinges on whether Yun is right about the future of mortgage rates. If Stiglitz is correct about the Fed's actions being the cause of spiking home prices, and if the Fed continues on that trajectory, contrary to what Yun says, we could be looking at increases in both prices and mortgage rates for 2024. But if Yun is correct, we could be looking at a much more balanced market with more people able to afford homes. There are two different economic camps with different explanations for our current inflation at play in most of the housing market predictions you hear about. The first camp is the old school economists camp. This group believes in the traditional economic theories and models that have been dominant since the 1970s. These theories often emphasize the importance of controlling inflation using monetary policy, usually in the form of rate hikes, sometimes even at the cost of higher unemployment. This is the idea that currently drives the Fed. However, the Fed didn't start this way. They initially believed that inflation was transitory and kept rates low. In 2022, either they got impatient or lost faith in the transitory theory and decided that inflation wouldn't come down without rate hikes. They started the hikes in January of 2022 when rates hovered below 4% and have continued for almost 2 years, seeing mortgage rates double in that time. These are the people Stiglitz is criticizing when he says the Fed is responsible for today's high home prices. The old school camp was the group that failed to predict the 2008 housing market crash, and newsflash, according to Stiglitz, they were wrong about the COVID housing market crash as well. Both Stiglitz and this guy, Galbraith, believe that we now have the data to show which of these two groups is correct, which we'll get to in a minute, but first let's look at what camp number 2 believes about the economy. Camp 2 is the critics camp, which includes Stiglitz and other economists like Isabella Weber, L. Randall Wray, and Yeva Nersessian. Unlike the old school economists who predict persistent and accelerating inflation, the critics believed that the inflation experienced during the 2021-22 was transitory, mostly driven by supply chain issues and global shocks like the Russia-Ukraine war. They argued that the inflationary pressures were temporary and would subside without necessitating aggressive interest rate hikes. This group had a different perspective on what drives inflation and what actions can suppress it. They're not fans of excessive rate hikes to get prices under control.
The Fed does not really have a lot of tools for affecting the level of the macroeconomy. It does have a lot of tools for financial stability purposes. So I would say the Fed was not created to manage the macroeconomy. The Fed was not created to manage price stability and full employment. It was created to prevent financial crisis.
Looking at the pandemic housing market and the broader economy in hindsight, we now have the data to know which of these camps is correct. Let's look at Stiglitz's arguments for why the old school camp is wrong. First, let's look at what he had to say about car production during the pandemic because it offers a key idea in his theory that pandemic inflation was transitory. Recall that we initially experienced a car shortage simply because there was a shortage of computer chips, a problem that took 18 months to correct. The issue was not that we had forgotten how to produce cars or lacked trained workers and factories. We were just missing a key component. Once it was supplied, automobile inventories expanded and prices came down. Disinflation set in this and several other cases, prices actually came down as well. Now he goes on about housing. Housing provides another example of this temporary self-correcting phenomenon. The pandemic induced people to look for greener pastures. Major cities like New York came to seem less attractive than places like Southampton in the Hudson Valley. He goes on to say that quickly creating housing inventory for a large number of people moving to a new area is not an easy task, and it did cause prices to rise. But as the effects of the pandemic have waned, prices have drifted slowly down. So what does this have to do with the Federal Reserve? Stiglitz says, given that its interest rate hikes did not help resolve the chip shortages, it cannot take any credit for the disinflation in car prices. Worse, the rate hikes probably slowed the disinflation in housing prices. Not only do significantly higher rates inhibit construction, they also make mortgages more expensive, forcing more people to rent instead of buy. And if there's more people in the market for rentals, rental prices, a core component in the consumer price index, will increase. So that's the end of his quote, but let me expand a little bit on this idea of how pushing buyers into the rental market increases rates. The consumer price index is a key measurement the Fed uses to decide if they're going to raise rates. If pushing people into rentals raises CPI, as Stiglitz says, that would have a cyclic effect. So higher rates would equal more renters, equals higher CPI, equals higher rates. Stiglitz also mentioned here that housing inventory was decreased by the rate hikes because they made it more expensive for builders to build. What he didn't mention was how the rate hikes locked sellers into their homes, which has limited existing home inventory as well. If the Fed's actions hadn't limited inventory in these ways, prices could have adjusted to the post-inflation environment. At least that's the theory. Now, these theories aren't making any predictions about 2024's housing market, but they lay a good groundwork of understanding what Yoon is predicting to happen. Because depending on which of these economic theories drives policy, it'll give us a pretty good idea if he's right in his prediction. First, let's get an overview of what he says is currently happening in the housing market. 2023 has been dominated by high mortgage rates and low housing inventory. Mortgage rates reached a 20-year high to around 8%, deterring buyers and leading to fewer sales opportunities. Home sales have fallen by 18% in 2023, adding to a 17% decrease from the previous year. Business spending has slowed down, but jobs data is positive. However, we are teetering on the brink of employment numbers shifting to the negative. So this is all stuff that has been in the news for a while, but here's where it gets interesting. According to Yoon, usually there's about a 2% spread between the Fed funds rate and mortgage rates. So if the Fed funds rate is 5%, typically mortgage rates will be about 7%. The difference between the two is the costs and profit of the mortgage companies, but right now that spread is 3%. Mortgage companies are cleaning up, so why is the spread so big? There's a few reasons this could happen, but mostly it tends to be tied to a feeling of increased risk. In a nutshell, lenders are currently charging higher than normal rates because they believe in one or more of the following things. One, inflation will continue and it'll cost them more to hold future mortgages at today's rates. Two, they believe the Fed will continue to raise rates. And three, they believe these things will lead to fewer people being qualified for a mortgage. What Yoon said next is the reason he thinks these presuppositions by the mortgage companies are about to change. He said, the bond market is forcing the Fed to pivot. Investors often turn to bonds because they're safer. When they're worried about future yields and the economy causing people to default on future loans, they move into bonds. This is why Yoon said, I believe we've already reached the peak in terms of interest rates. The question is, when are rates going to come down? Yoon believes they'll be down by spring. But is that a realistic interpretation of what the Fed will do? 2 months ago, the Federal Reserve said they don't expect inflation numbers to reach their target until 2026. Inflation has been the driving factor behind the Fed's rate increases. Fed Chair Jerome Powell also said that just because they had held rates steady doesn't mean they're done hiking rates. This language doesn't sound like they're getting ready for some rate drops to me. So why does Yoon think rates are coming down? There are two reasons. Before I give you those two reasons, if you need to buy or sell a home in the Raleigh area, I've got one of the most informative real estate websites out there. You can find a link for that as well as to register for my newsletter in the description below. But why does Yoon think rates are coming down in the spring? The first reason is inflation numbers. Inflation rates have been on the decline, although at 3.2%, they're still higher than the Fed target of 2%. But Stiglitz believes current inflation rates should be incentive for the Fed to stop rate hikes and maybe bring rates down. He said that the 2% inflation target was pulled out of thin air. There's no evidence that countries with 2% inflation do better than those with 3% inflation. What matters is that inflation is under control, and that's clearly the case today. But that doesn't mean that they're going to listen to him. The other way mortgage rates could decrease is the mortgage companies could decide to charge less. In Yoon's address, he said the 10-year Treasury yield is at 4.4%, which historically means that mortgage rates could be at 6.4%, but they're much higher. I have the feeling that Yoon believes that even if the Fed doesn't drop rates, that much of the uncertainty that is causing mortgage companies to have that larger cushion between the Fed rate and what they're charging will work itself out between today and spring. What do you think? Will the housing market be back to normal in 2024? Tell me in the comments. If you like this video, you might like this one as well.